Hi there, I'm Edward Kalstien, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Schneider Electric, a French multinational in energy management, automation and digital solutions. Schneider sits at the heart of the global energy transition. The big question is, how does Schneider Electric stock stack up based on the fundamentals? We'll analyze Schneider using our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. We look for companies leading their industry in capital returns, showing they know how to turn investments into real profits. Schneider Electric reports a return on invested capital of 9.5%. and a return on equity of 14.6%. Looking first at return on invested capital, Siemens Energy is at minus 0.1%, reflecting recent operational struggles at Siemens Gamesa. GE Vernova sits at about 1.7%, though limited historical data makes this less reliable. ABB leads the group with 14.7%. That places Schneider in the middle, stronger than Siemens Energy and GE Vernova, but not at ABB's level. Now on to return on equity. Schneider comes in at 14.6%. Siemens Energy is slightly lower at 13%. GE Vernova is higher at 16.4%, again based on limited data, and ABB tops the group with nearly 27% return on equity. So while Schneider shows solid, consistent returns, it trails the top performer ABB, but still ranks above Siemens Energy and close to GE Vernova. Can Schneider deliver meaningful earnings growth? Revenues grew at a compounded annual growth rate of 4.1% over the last decade. Net income grew with a CAGR of 13.1% and earnings per share grew in line with 13.2%. Key drivers include rising demand for smart grids and electrification, expansion in data centers and industrial automation, investment in Internet of Things, and digital platforms like EcoStruxure. Schneider doesn't just generate power, it makes sure the energy we already have is used more efficiently. And with global demand rising, that role is becoming more essential. Strong growth is only sustainable with healthy financials to back them up. Schneider has 6.9 billion euros in cash and short-term investments, and a total debt of 16.3 billion euros, so they can't fully cover their debt with cash. Debt to equity is 0.5, which has been decreasing from 0.6 in 2022. With a free cash flow of 4.6 billion euros versus 16.3 billion euros in debt, which results in a healthy free cash flow to total debt ratio of 28.2%. where 10% is the bare minimum. This shows Schneider is operating with relatively low leverage and steady cash generation. Even great companies can be poor investments when investors overpay. So how is Schneider valued today? Schneider has a price to earnings ratio of 32. For comparison, Siemens Energy trades at 85.7, which is much higher. ABB is 29.7, slightly lower than Schneider, and GE Vernova trades at 146.4. From a PE perspective, Schneider is closer to ABB, reflecting a similar business profile and steady earnings, while Siemens Energy and GE Vernova's PE ratio is much higher, indicating a very different market pricing. Now let's look at the PEG ratio, which accounts for expected growth. Schneider's PEG is 2.28. based on forward long-term analyst estimates of 14% earnings per share growth. Siemens Energy's PEG is 2.09 for reference. On this basis, Schneider appears overvalued relative to its expected earnings growth. Finally, let's look at Schneider's moat. Schneider has a diversified portfolio across automation, electrification, and digital services. EcoStruxure platform helps create recurring sticky revenues through software and service integration. Schneider also has a strong positioning in fast-growing areas like data centers, building efficiency, and industrial automation. But here's the flip side. Unlike Siemens Energy and GE Vernova, Schneider has little exposure to power generation, where big renewable investments are flowing. ABB remains a strong competitor in automation and electrification, often outperforming Schneider on capital efficiency and returns. Schneider's moat relies heavily on EcoStruxure, but if clients push for open, interoperable systems, its customer lock-in advantage could weaken. So what does this mean? Schneider's moat is solid in efficiency and automation, but it's not untouchable. Limited exposure to power generation, ABB's efficiency advantage, and potential digital disruption could challenge its long-term strength. Now, before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Here's what our 5 key factors reveal about Schneider Electric stock. Return on invested capital of 9.5% and return on equity of 14.6% is solid, but below main competitor ABB. Earnings per share has grown about 13% annually over the last decade, driven by smart grids, automation, and digital services. Debt is relatively low with strong free cash flow generation. A price to earnings ratio of 32 and a PEG ratio of 2.3 make Schneider looks pricey relative to growth. Schneider is strong in automation and digital services, but weaker in power generation and facing ABB's efficiency edge. Schneider is efficient, profitable, and positioned for the energy transition. But with a rich valuation and strong competitors, the stock may already be priced for perfection. How do you see Schneider's role in the energy transition? An efficiency leader worth watching or priced too high compared to peers? Drop your thoughts in the comments, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.